What's up everyone, this is Investe, and today we're breaking down the risk profiles of two companies, which are Nebius and CoreWeave, and try to find out which company carries more risk. As you already guys know, it has not been a great week for either stock. CoreWeave is down about 27% and Nebius has dropped roughly 18% within just 1 week. In my view, this sell-off was mainly triggered by concerns around AI CapEx risk, so today I'm going to break this down using leverage ratio, capital intensity metrics, and execution pressure so we can compare them properly. So let's dive in. Okay, let's start with the leverage. On a trailing revenue basis, CoreWeave has about $21 billion in debt against roughly $5 billion in revenue. That gives you a debt to revenue ratio of about 4.2 times. Nebius, on the other hand, carries roughly $4.1 billion in debt against about $530 million in revenue. That produces a debt to revenue ratio of approximately 7.7 times. So here's the first surprise. Even though CoreWeave has far more debt in absolute dollars relative to revenue, Nebius is actually more leveraged. Now let's adjust for forward ARR. CoreWeave is targeting about $17 to $19 billion in ARR by end of 2026. Against $21 billion of debt, that's roughly 1.1 to 1.2 times forward ARR. Nebius is targeting $7 to $9 billion in ARR by the end of 2026. Against $4.1 billion of debt, that's roughly 0.45 to 0.6 times forward ARR. Now the picture flips. If both companies execute their ARR target, Nebius actually becomes less levered relative to its run rate revenue. So after adjusting for forward ARR and absolute leverage, I believe Nebius carries less financial risk than CoreWeave because the scale of CoreWeave's debt makes it more sensitive to capital market stress. Moving to the capital intensity, CoreWeave plans to spend 30 to 35 billion in 2026 against the expected revenue of about 12 to 13 billion. That's roughly 2.5 times revenue. Nebius, on the other hand, is modeled to spend 16 to 20 billion against the expected revenue of 3 to 3.4 billion dollars. And that's roughly 5 to 6 times revenue. So relative to revenue base, Nebius is deploying capital much more aggressively. But here is the key difference in between these two companies. Nebius has indicated that roughly 60% of its 2026 CapEx is already covered through existing cash, operating cash flow, and contracted customer inflows. If total CapEx is 16 to 20 billion, then approximately 6.4 to 8 billion dollars remains to be funded. That remaining exposure is meaningful, but it's not the full headline number. However, CoreWeave, on the other hand, has not disclosed a clean person-funded figure. The management has emphasized that CapEx is tied to signed contracts and supported by a large backlog, but funding visibility is less explicitly quantified. So the takeaway is simple. Nebius has a higher capital intensity relative to its current revenue scale. CoreWeave, on the other hand, has larger absolute exposure and heavier reliance on structured financing. Both companies are aggressive, but when it comes to the capital intensity risk, I believe Nebius appears to be on the safer side because their funding visibility is clear and their cash buffer is stronger relative to their scale. And finally, let's talk about execution risk, because this is what ultimately matters. Both companies' risk profiles are heavily dependent on their ability to execute. CoreWeave is scaling from a much larger base. It already operates at roughly 5 billion in annual revenue today and is targeting approximately 17 to 19 billion in ARR by the end of 2026. That is a very aggressive growth, but it is scaling from meaningful current scale, supported by a substantial backlog and an established infrastructure footprint. Nebius, on the other hand, is targeting 7 to 9 billion in ARR by the end of 2026, starting from roughly 1.2 to 1.3 billion in ARR. That is nearly a 6 to 7 times increase in ARR within about 2 years. So the execution risk at that level means data centers must come online on schedule, power contracts must convert into active utilization, GPUs must be delivered and deployed without delays, customers must ramp consumptions as projected, and finally, margins must scale alongside revenue growth. If any of these variables slip, the financial ratio we discussed earlier begin to weaken quickly. CoreWeave's execution risk is still real, especially given the size of its CapEx program, but it is operating from a more mature revenue base and a significantly larger backlog. Because of these differences, I believe Nebius carries more execution risk, primarily due to its smaller scale and the level of growth pressure required to meet its target. Okay, so here is the bottom line. CoreWeave carries higher financial system risk due to its larger debt load and heavier reliance on capital markets. On the other hand, Nebius carries higher execution risk because of its smaller scale and the pressure to deliver a massive ARR. Neither company is safe, they're simply exposed to different type of risk. And as an investor, the real question is not about which one is perfect, it is about which type of risk you're willing to underwrite. Thank you very much for watching, and if you found this breakdown helpful, make sure to like the video and subscribe for more deep dives like this. I'll see you guys in the next one.